All right, what is up, and welcome back to another super amazing, excited. I can't even get it right. Welcome back to How to Invest in Commercial Real Estate. Interest.
What's up? Yeah.
So today's cool episode. We bought this amazing smart board to use on our podcast a couple years ago. We've never used it.
Today's the day.
Today's the day. So we're forcing ourselves to use it. So it should be pretty cool. A lot of people don't like. We've never done this. We kind of conceptually talk about it, but the idea of being able to walk through these deals live, we're going to look through some offering memorandums. We're going to model up some deals together. We're going to and we're actually looking at this stuff, which is cool. Like we're actively negotiating, offering, trying to buy
these two that we're going to go over.
These assets. Exactly. So, yeah, it'll be interesting.
What I would say is this is probably some of the best experience that we can offer everyone watching. So if you are a listener of the podcast, check us out on YouTube because you'll actually be able to see us walking through these OMs. But part of what we do, all the experience that we've gained looking at thousands of deals come into play when we get these OMs, and we have to quickly analyze, is this a deal I want to look at? Why do I want to look at it? What are my risk points? What are the upsides? And how do I quickly put it into a model and see, am I going to get cash on cash and IRR returns that my investors want? And so here today, we're going to do it live for you, or not live, but you'll see the recording next week when the episode comes out on just how we go about doing that.
Yeah, so I think the common misnomer is you find this property that you love and then you model it. I think I'm here to debunk that today, right? It's a numbers game. It's like sales. It's like knocking on doors. You have to underwrite and model as many properties as you physically can. Find some basic parameters. I believe we have an episode of like 7 basic parameters of the first litmus test. And then the ones that meet those basic parameters, you have to be underwriting 20 deals a day if you can. If you have the ability to underwrite 20 deals a day, whoever you're pitching it to, your investors, your partners, anyone, that's how you hone in your modeling skills, and that's also how you find amazing deals.
Yeah, I'll compare it to how I go about buying cars. In Tulsa, Oklahoma, if I want to buy, let's say, a BMW, there's only so many BMWs in Tulsa, and I can get a sense, okay, they're all selling at, $35,000, $36,000, $34,000. But then when I look nationally, that same model with the same mileage, I might find one in Florida that's $29,000. I might find one in California that's $50,000. And so the only way if you're getting a really good deal, or the deal of the decade, as we like to say,
shopping,
is if you can look at hundreds. And same with homes. When we were first buying houses, driving markets, the first house you look at, you're not sure how good the deal is. But after you've looked at 500 houses, you're going to know which ones are the best deals. All right, so I'm going to head up to the board, and then we're going to go through, yeah?
Get up there.
All right. I'm not sure how the audio will work. It won't.
Yeah, that's a great point. Yes, we're going to have to commentate a little bit.
Okay.
Man, the back of your head looks great. Okay, so this property is called West Ridge Plaza. It is located in Topeka, Kansas. We drove up there a couple of weeks ago.
How did we first come across this one? Remember, broker, or just got it? Just an email to us.
Andy, the Woodmont company they were managing it or servicing it.
Yeah, I think Andy did bring it up. I think Woodmont definitely did use to manage this for the special servicer. A special servicer has it now, so it went into some sort of receivership. Which is probably why it's transacting right now. You may have to pinch it to zoom out or just scroll. Yeah, that works. So again, this property is located in Topeka, Kansas. We went up there a couple of weeks ago because we initially placed a letter of intent that, a lot of other people were placing letters of intent, and they had a best and final. So one of the things we do in a best and final is make sure to get a property tour going, just so they know we're serious about the site. We're willing to invest our time and our money and our resources to go up there and tour it.
All right, what's the first thing you guys notice on this picture right here?
Full parking lot.
Full parking lot. That's exactly what it looked like when we went.
Yep. Yeah, it was full.
Totally full.
And it was the middle of the day on a Tuesday or something.
Also, it might be a little older center, but the facade is in great condition. It's a sharp-looking center.
Yeah, it does look good. The facade's in good shape. I believe they have new roofs in 2020. About 90,000 square feet. It looks like almost 14 acres, so a big property.
So anchored by Target,
Yeah, a lot of those are public companies. You can get placer data on these tenants. We have got placer data on these tenants, which is just a tool we utilize to measure performance of some of these stores. It kind of reverse engineers sales. It's a pretty cool product. Yeah, so here we're looking at the rent roll, right? And this is the list of tenants, the square feet they occupy, and the percentage they are in relation to the rest of the center. One big thing I like to look at here is just, I kind of like having tenants under, 10, 15% of the total gross leasable area, just so you're not, putting all of your eggs in one basket. Obviously, this is, some junior anchor, larger box space. You've got a TJ Maxx at 25,000 square feet. That's like 27% of the center. And that's probably your biggest tenant. So yeah, we utilize that placer data and the feeling of the parking lot, how busy the store was inside. I know Joel was freezing that day, so he went in and bought
my first purchase.
a little hoodie there. I was flying the new drone after I flew it into our office building. I got a new one. But anyway,
What we really liked about this is you can see here the strong retail corridor. Tenants, retail, very strong retail corridor right there. We're not out on an island. We're not all by ourselves.
No, all four corners we're pretty busy and we're full of retail.
yeah, so those are good points, and everyone kind of has those corridors in their city. But in neighborhood and community shopping centers, you can definitely find some that you're all alone, maybe in just a sea of houses or by a bunch of manufacturing or jobs or something. But being in a corridor of tons of other shopping and places to eat, if somebody's close by, the probability of them stopping at your shopping center as well and spending additional money is really high.
A couple of things: strong Target anchor, also strong gym anchor, and it includes one of the out parcels.
Yep. So you're not buying the Target, but obviously this is kind of what we would call a shadow anchor. So it's not in your center. It's obviously really close by. Target is a massive driver. So just being in the proximity of them, again, the probability of somebody coming into Target and going over to one of these other tenants is very high. Keeps the parking lot full. And then again, you have that corporate Hardee's there on the corner. So corporate Hardee's, you have the ability to kind of spin that off for additional upside. I think this property is listed at like an 8.5 cap. That Hardee's is maybe worth a 6.5 cap, ish. So you got a couple points of spread there. Again, just kind of penciling additional upside.
You can see there they spent $250,000 on the roof. They've improved sidewalks, paint. Lots of CapEx they put into the center.
Yeah, I did. I actually didn't see that in the first pass of this. They have invested a ton. Just that they got that much roofing done for $250,000, you can tell they did it 3 years ago, right? Roofing has doubled since then. Yeah, so a lot of location overview here. It's going to give you demographics of how many people are living in 1, 3, 5 mile radius, how much money they're making, whether or not they have a degree, the percentage of them, at least the average home value, average household income, spending power.
I like to see average household income if we can get above 75,000. If it's down to 40, 50,000, you're looking at more workforce housing, lower income.
Yeah, and what I would say is that's not always the first deterrent, but you need to match up your tenants to your demographics, right? When you see an average household income of $77,000, going back to the Target, TJ Maxx, gym, I mean, it fits. Massage Envy. Even though in this economy, I don't know, if 75,000 household income, you're getting a massage on the weekend. Probably not.
Yeah, probably not.
Sally Beauty, Great Clips, Famous Footwear, very common tenant lineup, I would say. Nothing too out of the ordinary. Crumble Cookies, those are bomb.
So the next thing we do is go to the rent roll and we see, okay, what do our leases look like? Are they expiring? Hardee's is out to 2029.
I can't see them from here. Are there any that are due next year?
Pizza is 2024, September. That's a little close.
Mm-hmm. Yeah.
So we want to dig on how they're doing. Dream Nails is out 2031, 2028, 2031, 2029, 2029.
Yeah,
so that's
nice.
good. You want to see 4 or 5 years down the road.
Yeah, I think some people that in the industry call that the WALT, or the weighted average lease term of the gross leasable area. Your lender is going to look at the average lease term, and you really just want to be looking, okay, do I see any immediate exposure? Do I see any tenants that are not doing well and probably not going to renew? Or the opposite, do I see tenants that are expiring soon that are under market? Do I see immediate upside to where we can renew those leases and capture additional value immediately?
One thing I look for with the largest tenants is I want their rent to be lower than the smaller shop spaces, because if they bail, I want to make sure I can backfill. And here the rents are running $15 to $20 a foot, but TJ Maxx is less than $10, and Dollar Tree is also less than $10, which is good. The lower you can have the rent on the bigger box, the safer you are in case they bail. Mm-hmm. Dollar Tree doesn't have a ton of time left, so that's something we'll have to look at. TJ Maxx 2027.
Yeah, Dollar Tree, TJ Maxx, definitely expiring in the next few years. What's Dollar Tree at per square foot? $9.50.
Yep.
I like Dollar Tree at $9.50. TJ.
It's pretty average for them.
Yeah, TJ Maxx, it looks like $9.75. Honestly, I like both of those where they're at. I'm not super worried. I'd like to go back. Okay, so it looks like they're doing a potential cash flow for us here. This could be interesting. Guys, this is not your model, right? Holy cow. It's like going and buying a brand new BMW and listening to them on how much it's going to cost to maintain. Oh, nothing. It's brand new. Like, no, it's going to be... It's going to be different than this. Like, this is the best case scenario from the broker trying to sell you the brand new shiny car. Like, just don't even use this. You're looking for day one NOI. Use your own assumptions from there. All right, Brian, I got us a little copy over here. So while Joel is moving back over, this is just a quick and easy model. Obviously, the longer or the further you get into the project, the more you're going to hone this down. But just quick and dirty, right? We're looking at a net operating income of $1,349,651.
And so we're offering 14.7. What is that on the cap rate?
9.18.
Yeah, which for this center, it's a really nice center. We think getting it above a 9 cap in today's market is pretty good. With the target anchor and the traffic counts and everything, we really like it. So then we have to put in some assumptions on fees. Typically, let's see, it looks like we put a full point on the lender. You could do a half a point to a point, depending on what lender you're going to use. Then closing costs at third party and legal. Typically you're looking at $15,000, $20,000 in closing costs. Our lender legal is not lender legal, but our legal fees are probably about $15,000 a deal.
Yeah, probably less than that. Maybe like 5, 7 now.
And then you've got your third parties, which is appraisals, which is environmental, which is a property condition report, maybe a roofing report. And so we throw in a few $1,000s for those, maybe a total of $5,000 to $8,000. And then you can see there we're charging an acquisition fee and then 1 point on a mortgage guarantee fee. And then we've got $300,000 of working capital.
Yes.
Yeah, so what is that? Go ahead.
Well, I was just going to, so what did we do? We did 2%. We just assumed about 2%. We did have a little bit of problem with the parking lot, right? It looked like it might need some repairs. There was actually snow on it. You could see where it had been scraped. So we had a little bit of concern there. So I don't know if we put a little bit more in for that, or is 2% sort of a starting point for us, or did it just happen to be 2%? And you...
I was just going purely based off of the fact that as a relatively new roof, we have limited exposure there, and the usable life of that roof is 20 to 25 years, I would say. So I know we have a little bit of exposure over TJ Maxx. I think that has an older roof, so you've maybe got 25,000 feet that you may have to replace.
Yeah, I think it's a starting point. The bigger the deal, the lower the percentage. The smaller the deal, the higher the percentage. Obviously, you're buying a $2 million deal, maybe 2% isn't quite enough working capital. But once we get into the deal, this is just LOI stage. We can always go back to the seller and say, hey, the parking lot needs repair, and try to get a credit for some of that to help make up this number.
Yep. Okay.
Yeah, and what I would say is, for those of you listening for modeling tips, I go in a little bit heavier on the cash, pending the deferred maintenance, like how old the roof, parking lot, et cetera, how vacant the center is. So I go in heavy on the cash, and I want the first pass of my model to be really good, right? because shit's going to happen. I'm going to find something that I don't like. The NOI is going to come down. Parking lot's going to be shit. There's going to be something that's going to eat away at that constantly. It's rare that in modeling the models get better.
Yeah.
Right. They're typically getting worse because you're finding out new factual information instead of assumptions. And
I would say about 50% of the time, the seller, you're going to be able to get some credit out of the seller if you've paid for third-party reports, and those third-party reports uncover things that you may not have been able to know in just glancing at the property. Yeah. And so they know that, well, okay, I don't like that they're asking me for $100,000 for parking lot repairs, but if I take it back out to market, I got to try to get another buyer, and then that buyer's going to do the same inspections, and they're going to come back with the same findings. So I might as well, work a deal with the seller or the buyer that I have now.
So the next point, we've got kind of our acquisition cost assumptions. Moving over to the income and expense details, there's going to be a lot of people who hate us on this, I think. Like, there's going to be so many people who use Argus models and discount, every single tenant to a different cash flow number based on the associated risk. And I'm just going to say that's why you don't buy anything, because you spend too long on your models. That's just the reality of the situation here, guys. We like to model NOI and kind of grow that. And then again, as we get into the deal, we're getting way more detailed on the income and expenses. We'll build out a 3-year cash flow projection. And that's really where we get into the nitty gritty about what we actually believe free cash flow is going to be. But right now we're trying to be optimistic because, again, we're looking at a lot of these. We need to effectively work through a bunch of models and a bunch of deals. And from our experience, in a normal good piece of real estate, you can grow NOI by 2 to 3% a year fairly easy.
Now, what we would do if we moved to a purchase, like Braden said, is we would go into the rent roll that we kind of scrolled through earlier, and we would actually look at exactly what the increases are for each tenant, and then build the NOI per year based on that. That takes a lot of time, and so we just don't have that kind of time. Most of the time, tenants are going to have some types of increases, whether it's yearly or whether it's 10%, at the end of year 5. And so 2% is a great model. And you can see, Braden, I think we grew it 2% for the first few years and then backed it down to 1%.
It's a large NOI too. On a smaller deal, I may be a bit more aggressive with that. Like I said, I may go up to 3% on NOI growth. But again, we're already at 1,350 on the NOI. So you don't have to be too aggressive, in my opinion. And again, most of these tenants are probably going to have those 10% every 5-year increases anyway. So probably not going to actually realize 2% every single year. It may be, 7% year 3, 3% year 4. But anyway,
we have a debt quote, 75% LTV, 6.6 on the interest rate, fixed for 5 years and amortized over 25. I think the feds came out yesterday and they said they're pausing increases and they expect 3 rate cuts next year for a total of about 0.75, 3/4 of a point. Yep. And so if we can get this to model today and rates come down, the deal only gets better over the next 2 or 3 years. If we can refinance at that lower interest, as we've talked about in other shows, it gives you a chance to increase your cash flow.
Yeah, and I'm not even to the point where I'm doing that yet. Like I'm not factoring in that, because are we going to refinance at the end of next year because it came down 75 basis points when we believe it's going to continue to come down?
No, we would wait. We would wait at least 2 or 3 years.
That'd be hard to model. Hard to know exactly what we would do and what the interest rate would be at the time.
But again, it's a data point, right? It's additional upside. Like the Hardys that we're not modeling a sale on, it's additional upside should we choose to look at it. So not being insanely aggressive on the LTV, we're looking at 75% loan to cost. That was a quote from Arvest Bank. They're a decently sized bank in the Oklahoma region. I know this asset's in Kansas. They're interested. They've got a branch in Texas. So Arvest Bank has been...
And they're out of Arkansas, so they're in the region.
Yeah. A big bank. We've done several deals with them before. I know you've done some... Anyway, Arvest Bank. So equity details, distribution, assumptions, kind of this top right corridor here. We're looking at a preferred return of 8% and then a 70-30 split, 30% going to the GP, 70% going to the LP. I would call this the criterion boilerplate on a deal.
Yep. So you look down there, you can see LP net to invest. That's the amount of money we have to raise to buy the deal, and it's $4 million. So it's a pretty hefty equity check, based both on the deal being a pretty large size and also because we're at 75% versus 80% on the loan.
Okay, so this next box is the most important box. And I would say if you learn anything on this show, right, you're probably a limited partner. You're probably investing in somebody else's deals. This is how people get IRR. They have these crazy exit cap assumptions. And it's I don't know, it's the easiest way to manipulate IRR in a deal is what you're selling it at. And that's kind of the biggest assumption you have to have is an exit. So, in a good economy, in normal situations, we don't typically underwrite cap rate compression, which is what you see here. You see our cap rate on our purchase price is 9.18, and our exit cap assumption is 8.25. So I guess why, in your guys' thoughts, do we feel comfortable doing that today?
I would say this deal 2 or 3 years ago is selling at an 8.25.
Yeah. Mm-hmm.
Rates went way up over the last year or two, and retail cap rates have been moving up. I don't think I ever saw a deal this clean, this nice, next to a Target, with this, many cars in the parking lot, the nice facade that it has, at over a 9 cap. That just wasn't a deal we saw 2 years ago. And we've purchased deals like this for 8.25, 8.5. So I think it's reasonable. I think as rates come down, there's been a lot of money hanging out on the sidelines. I think it's going to be wanting to get invested. So I think there's a chance we get it. Obviously, we're modeling that at 5 years from now. So it's hard to know for sure. I don't think we're going to be way off either way. Could we get an 8? Maybe. Could we get 8.5? Maybe. So all we're trying to do here is be reasonable. And you just want whoever you're investing with, you want them to be reasonable. If we had a 7 on there, that's not reasonable. And so you just don't want to be taken advantage of on that and think that, well, he's promised me 20% IRR, but that 20% IRR is based on a sale price that's never going to happen.
Right. The next box there, our total cost of sale. This is what we would pay a selling broker for. Again, with a deal this size, I feel comfortable with 3%. That's like $500,000 between a listing broker and a buyer broker. If they're getting $250,000 each, I feel like I could negotiate that deal.
I think you could do it for 2, being $18 million.
I think you could negotiate that deal. yeah, I think so. On a smaller deal, it may be more, guys. It may be 4, it may be 5. Again,
that's something you have to keep in mind. If you have a $1 million commercial property, that's the fee's going to be 5 or 6%. If you have a $20 million retail property or apartment deal, you could be 1.5, 2, maybe even 1.
It depends if you're a repeat customer, how much, a lot of things, a lot of variables. But this is right. If at any point, I love this. If at any point you're going through the model and you're just like, man, I have no idea. What if it's 5? You shouldn't be modeling.
Yeah, you should have an idea.
You should just stop right there, right? Every single one of these boxes, if you don't know, you should call somebody. And there's 50 brokers I know in Tulsa at least that would be happy to give me their opinion on an exit cap and a cost of sale. You average those together, you're going to get a decent data point to throw in a model. Okay, disposition fee 1%. That's standard. Brian, can you hit that analysis button for us? Okay, so this is the juice, right? 1 page. I probably filled that out in 60 seconds the first time I did it. Swear to God.
Well, you're going to have to pinch it, Brian.
You're going to have to give us a pinch. Nope. It's not. There we go.
That's good
fine.
Enough right there. Yeah.
Don't get too handsy. Okay, so here's what we're looking at here. The first page was our inputs. Now we've got all of our outputs. So we see in the top left, the year 0 equity in is about $4.1 million. And our modeled cash flow after debt service that first year is almost $500,000. Next year, $448,000. Why does it immediately dip the first year? Joel, why does it immediately dip?
Because when you first get the loan, your first payment isn't due for 30 days. So that first year, you only have 11 debt payments. And so that's why your cash flow is a little bit better in year 1 than it is in year 2, where you have a full 12 months of debt payments.
Yeah, so right off the top of our head, we can see here that it meets a normal debt service coverage ratio, 159, 148, 151. Banks are going to love that. I would say a minimum in a good, or I would say reasonable is 1.2, 1.25. More or less is obviously acceptable. It looks like the total cash on cash for the deal is 12.17%, assuming one person bought it by themselves and didn't split it up. So these are good metrics kind of for us to use and people to use. Obviously, there's a waterfall that we can continue to go through.
A couple comments I have is you have average cash on cash to the investor of about 11%, maybe a little less, 10.75. Yeah. So anything double digit to the investor cash on cash wise is good. You have a 5-year equity multiple of 2, a little over 2. You've got a IRR, 5-year IRR of about 18% to the investor.
Which, first of all, you can stop right there. Average cash on cash, which means quarterly dividend of 11%. My 5-year IRR, or my 5-year yield after this is all said and done, is about 17.79% per year for the 5 years that it's invested. And you doubled my money over the 5 years.
Yep. That's really what our goal is to hit that 18 to 20 IRR, which is doubling your money in 5 years.
And that's for the LP, right? Like we're making money in addition to that.
Yep.
That's just for the limited partner. That's their 8% preferred return and 70% of every percent after 8, right?
And so one other comment on you'll see there, the investor IRR year 1, it's 26. So that looks good. What's the deal there? Well, the model has to, assume an exit or a sale of the property, and we're not going to sell it next year at that 8.25. Obviously, we're going to have interest rates come back down, which is going to cause cap rates to be able to come back down. And so, really, you only want to take that IRR number in the year that you plan to sell it. That's when it's applicable, and that's what we're using as year 5.
Yeah, I would say the magic number is 60 months. Like everyone kind of underwrites to 60 months. If you're planning on buying and holding it, like 7 years, 10 years, 8 years, 9.5, we underwrite to 60 months every single time.
So, we planned on doing 2 or 3 deals for you today, but we're already over time, so we'll have to do another episode with a few of those other ones. But we just this is an actual deal that we're going to try to buy that you might have a chance to invest in. And this is our quick down and dirty underwriting that we did before we put in an offer last week or earlier this week. And
we drove up there. We spent 1 full day in the car.
Yeah. Oh my gosh. Over 4 hours to Topeka.
Yeah. And we spent about an hour. So this is about 9 hours in the making. An hour modeling, 8 hours in the car on our second drone. But, we may get it. You got to swing for the fences, guys. This would be our biggest deal to date, and we're excited. We're super excited. So hopefully we get this deal awarded to us. Hopefully everything is great while we're in contract and due diligence, and we don't find any, skeletons in the closet.
What will be interesting now that we've done this and we buy it is that we'll be able to go back and see, okay, which ones of our assumptions were right, which ones were wrong, which ones did we miss, and which ones performed better than we had anticipated. Yeah, right. So it could be a little bit tough on us if we end up buying this and some of our assumptions don't go that well, but that's how you live and learn. We're taking all of our experience when we evaluate these deals and trying to make the best guess on how this thing's going to perform. So this will be a good test case.
Yep. Anyway, we may do this next week. We may wait a week or two, but we are coming up on Christmas, and I know we are doing our Christmas giveaway soon. We'll have to put this somewhere else in the episode so it's not at the very end where nobody sees it, but we're going to release it soon. So be on the lookout on our social media pages for the Christmas giveaway. It's coming up. It's going to be awesome, right? We're going to make it awesome.
Yeah,
I feel like we have to make it awesome.
Now that we've announced it as awesome.
Now that a lot of pressure, and it's going to be simple, right? Be on the investor list, which is easy to do. It's free.
Watch the podcast.
Comment, subscribe, share. You don't even have to watch it.
Yeah. They're not getting paid if they didn't watch the podcast.
We're not going to know that, so just don't tell Joel.
Okay. All right. Till next time, guys. Thanks a lot for watching.
See ya.